Welcome to another edition of Arrow Insights. My name's Kreston Leggett, one of the private client advisors here at Arrow Private Wealth. And today we're here to talk about accessing emerging thematics in private markets. And I'm joined with Ryan Synnot, who heads up our investment research and solutions. Welcome, Ryan.
Kreston, thanks for having me. An exciting topic today, accessing emerging thematics. Definitely one that investors get very excited about, but for good reasons. There's significant opportunities, accessing emerging trends, but I think investors need to have a deeper understanding of how that's evolved over time and potentially accessing them via private markets.
And I think it's fair to say that there's been a change in the interest and the focus on private markets over the past decade. Can you sort of speak to how that's come about and why investors are placing more emphasis on returns from that sort of asset class in particular?
So there's been a noticeable shift over the last couple of decades of companies staying private for longer. What you'll find today is that some of the largest companies in the world are in fact private. On the screen here, I've got a list of some of the largest private venture-backed companies, Australian companies like Canva, Epic Games, who are behind Fortnite and that gaming engine, massive companies that have been funded by venture capital for many, many years. Historically, if you go back 20, 30 years, you might have found these companies listing on public markets and then offering the returns for public market investors as they became more and more mature over time. But today what you'll find is that these companies are being backed by venture capital for longer periods of time, and a lot of those returns are being concentrated within private markets. So in order to access these businesses and these emerging technologies, we really have to push beyond public markets and look to form relationships with venture capital managers so our clients are able to access these businesses at an earlier stage. On this chart here, you'll see the growth in unicorns over time. A unicorn is a private company that has a market capitalization of over $1 billion. What you'll find is that many of these companies in the past may have listed on public markets earlier in their lives. However, today they're staying private for longer. Over the last 10 years, on average, a company is staying private for about 10.7 years, where if you go back only 10 years, it was much shorter than that. And today there are over 1,300 of these companies.
There's a really interesting point around unicorns and the private market space is growing considerably, and whether that's the new normal now and whether the term unicorn is now less relevant, so to speak. In terms of the class on the whole, you often hear that investors can achieve outsized returns compared to public markets. Can you give us a bit of insight as to how that plays out in terms of, for investors that have longer term time horizons to invest? Obviously, locking up their funds comes with a different strategy. So what we often term as an illiquidity premium. Can you sort of work through some of those benefits of investing in private markets?
It's a good point. I think the ability to lock up capital is a big advantage for the company. They're able to sort of execute and are focused on a much longer term horizon relative to what you may see of a publicly listed company, which is trying to manage results potentially year to year or even quarter to quarter. And what that allows an investor to experience is they're locked into an investment at a very early stage, and they're able to sort of be invested in that company all the way until it becomes a mature company. And that compounding element over that journey is extremely powerful. And what you'll see is you'll typically expect venture to outperform its publicly listed counterparts. You're investing in a higher risk market, so you should be rewarded for that. But just on this chart here, we've shown the performance of the Morningstar PitchBook Global Unicorn Index against broader global equities, and the outperformance is quite substantial. But that is to be expected when investing in this asset class.
Yeah, I love that name, Unicorn Index. It's certainly something different. So, in terms of our investor base looking to access private markets, how realistic is it for them to be able to get the right exposure and build that component into their portfolio?
Yeah, so if anyone's looking to sort of construct a venture portfolio themselves, it will be incredibly difficult. A lot of this market or this asset class is very relationship driven, and sourcing the deals yourself will be incredibly difficult. You have to be well connected, and in order to find the right businesses, and then they may only have a couple of outside investors as well. Another issue that investors may face is minimum ticket size. So often, when you're investing in these businesses, you'll need to be writing checks of, hundreds of thousands into millions of dollars, which can make it hard to build a diversified portfolio. Our preference for clients is to partner with a venture capital manager that allows them to take care of the deal sourcing, the screening, and the diligence of opportunities, and investors are able to benefit in a already established or well-diversified portfolio through a single point of access. So if they're investing, $100,000, $200,000, they might have exposure of up to 30, 40 companies under the hood. So that wouldn't be something that they're able to replicate themselves.
I suppose for the everyday investor, if we view this asset class as an important element of their portfolio, there's clearly some barriers to be able to introduce that exposure. So it's not necessarily just about having capital, but it's about having relationships. So how could the everyday investor sort of leverage their way to get that relevant exposure from your perspective?
Yeah, I think getting in touch with experts or specialists in the field that have a network of venture managers across private markets. There's a range of different strategies. So being able to talk to an advisor and get an understanding of what it is that you want within your portfolio, and then we're able to go out and find potentially someone who invests in the earliest stage, or someone that might invest a bit later on in a company's horizon once it's been potentially de-risked to a degree. I think advisors play a major role in this space and being able to find good solutions for clients.
You've outlined some really interesting and good points today, Ryan. What sort of investor should be considering this sort of strategy in their portfolio, and how should they engage in the next steps?
Yeah, so it's obviously an asset class that comes with a high degree of risk. So I think for investors, there's probably two main things. The ability to lock up your capital. It's not for everyone, but for investors that have long time horizons, it may be appropriate. And then obviously as well, a higher risk tolerance. So investors that are looking for a high degree of capital appreciation, I think that's where the asset class is best suited within portfolios.
On the whole, it's clearly an attractive thematic to look at in terms of portfolio construction, and for our clients, they obviously get the benefit of your expertise in this field. So thanks a lot for sharing your insight today on this topic, and for me to join in the conversation as well. So thank you to Ryan for presenting to us today on this topic, and we look forward to hosting you in the next session of Arrow Insights.